Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Wednesday, January 6th, 18th, 2023. It's great having you with me here today. We got two disappointing numbers. One, retail sales falling. We see even vehicle. We see Christmas not being as good as the market expected, a decline. And even if you take it down to the core number, which is the consumption mimic that we see in the retail sales, we see that be a disappointment. Talk about Christmas, non-store sales falling more than 1%, department stores falling 6.6% month over month. We had already seen a profit warning out of Macy's, so more brick and mortar establishments we continue to think are going to have problems, and the consumer. When you think about retail sales, you think about their nominal element, and you take that out. And since we've seen significant price increases still even today, we see a picture of a consumer who, October was good, November pulled back, and now December pulled back. What does this do for GDP? Yeah, we still think we're probably looking at a print north of 3. We've seen movement, particularly in the export side of the equation. That's helped. We've seen government spending continue to be helpful, and the service side of the economy continue to move along. So those should be enough to propel. Remember those two weaker quarters at the beginning of the year. Now we're moving ahead. So that's a positive for the economy. But when we saw with Empire and we see with industrial production, those interest rates are starting to take an impact. In industrial production, we would have expected continued improvement with the auto manufacturers, cars, inventories around 30 days. We usually see them around 60 days. So dealers are still short. There's very little discounting going on there. Prices 48,000 versus before the pandemic, 41,000 for an average car. So still a lot of push there, but we're not seeing the improvement. In addition, the eating out has sort of tapered off also. So the signs with only building materials going up, the signs are starting to build. And we're seeing that with interest rates. We're seeing interest yields fall. Concerns maybe possibly 4.5, 4 3/4 being the upper end for the Fed in terms of the rates. Maybe a struggle to get to 5, particularly with the numbers we're seeing right now in the economy. But we should, recognize that we have had quite a run. Retail sales are still over 680 billion per month. For the pandemic, 520. So yes, we've gone a long ways. We've gone a long ways quickly. Maybe a little retrenchment here, a little bit of adjustment. Taking off the inflationary elements would be very constructive for the economy, and that's helpful with the capacity utilization falling, showing there's a little more slack out there in the economy. Clearly, energy needs, we do expect oil output in 2023 to equal what we saw in 2019. So continued solid numbers there on the industrial production side. And this time of year with need for energy, waves of warmth and cold, but still chill in the air, meaning that the energy complex and utilities were kept busy in the December month. This is Scott Murray for the Daily Economic Market Shout. Thanks for joining me.